Hi YouTube, happy Monday. Today I want to make a short little video about stocks. First of all, what are stocks? So stocks or shares are basically where you can buy a percentage of a company, so you actually own part of that company when you buy a share. Each share is worth a certain amount of money, and that price is dependent on how much the company is worth. So if the company is worth a lot of money, you're gonna pay more per share. However, if the company isn't worth that much, then the stock price will actually be a lot lower. So I'm just gonna talk about a few different terms you might hear regarding the stock market. A bear market, which is what we're currently in, which is B-E-A-R, like the animal, is a market in which stocks are undervalued. On the other hand, a bull market is a market in which the stocks are going to be overpriced or decently priced. So in a bull market, the stocks are going to be worth more, or the majority of stocks are worth more, and the majority of businesses are doing good during that bull market, which is why it's called a bull market. If you think about the horns, and they kind of like, you know what I mean? They buck up. That's how I think of it, at least in my head. To buy a stock or a share, you can't just buy it at a store or anything. You have to buy your stocks through a certain brokerage. So a brokerage is pretty much the middleman. They connect the seller and the buyer, so the buyer can buy the shares and the seller can get the money, basically. So a few different common brokerages in America are Charles Schwab, Fidelity Investments, and TD Ameritrade. However, there are a few different apps you can use to trade stocks. One app I like to use is called Robinhood. It's an app on my phone that I can use to buy and sell stocks and keep track of all the money I've put into it, and it keeps track of what I've lost, what I've gained. Another really popular app on your phone is called Webull. It's just another brokerage you can use to buy and sell stocks. You might have heard of what is called a ticker symbol, and what a ticker symbol is it's a few letters that represent a company. So for example, Amazon is referred to AMZN for their ticker symbol. Basically, it's just a symbol they use to quickly identify a certain company or a certain business that is publicly traded on the marketplace. As you can see, the ticker symbol is right there. That's the company, and that is the current price per share. So if you see right there, the market cap, which is $1.16 trillion, is about how much the company is worth. So Amazon right now is worth about $1.16 trillion. The market cap just pretty much explains how much the company is worth. Another thing you might see on the Robinhood app is the PE ratio. The PE ratio stands for price to earnings ratio. Basically, the PE ratio helps investors determine whether a certain stock is overpriced or underpriced. Typically, with a PE ratio of 25 and higher, that is pretty much a high PE ratio, which can mean that the company is overvalued. However, a lower PE ratio, like 15 and below, can signify that the stock or the share could be undervalued. One thing you may not know about the stock market is that it is only open 9:30 to 4 p.m. Eastern Standard Time. The stock market is also closed on the weekend, so it's only open Monday through Friday, and it is also closed during holidays. So the most popular stock you've heard of is probably a growth stock. A growth stock is basically where the company is currently undervalued, so each share is worth pretty much next to nothing. That share is expected to raise in value pretty significantly, and that is why they're called growth shares or stocks, because they're pretty much meant to skyrocket, which is the main way people make money, which is by buying low and selling high. However, there are funds called index funds, and what index funds are, they're basically like just one share of an index fund has multiple companies in one share. So when you put money into an index fund, the people who run that fund invest the money for you into different companies, so you're pretty much buying fractions of a share all in one share. So index funds are a type of stock that is less volatile, and it's kind of a safer way to invest your money. It's more of a long-term investment though, because these things, they take time to build value. So one example of an index fund is this fund right here. It is called Invesco QQQ, and the ticker symbol is triple Q. So as you can see here, This index fund puts shares into Apple, Amazon, and Google, just a few different examples of things they invest into. So this certain index fund actually gives dividends. So they pay about 52 cents per share you hold. So if you own 2 shares of this index fund, you'll get paid about $1 a month. Another example index fund is this fund right here. So this is the Invesco S&P 500 high dividend, low volatility ETF. So what that means is, in this certain index fund, they are going to invest your money in companies that give high dividends but are also not as volatile as a share like Tesla. That was a short little video about stocks. It's just basic info. I do plan on making a video about my stock portfolio on Robinhood. Like the video if you liked it. And other than that, have a good day and thank you for watching.